This is InvestTalk. Independent thinking, shared success.
Hi, my name is Nima Saram. I'm a student at Purdue University. I listen to you guys' show all the time. I wanted to get your input on Oklo, O-K-L-O. I invested in them a few months ago, and they've done for me very well, and I wanted to see your insight on that in the nuclear industry. Thank you. Bye.
All right, looking at Oklo, OKLO is the symbol and the name of the company, and they design and develop and deploy advanced fission power plants and small modular reactors. So this is an area that has a lot of interest, a lot of hype, and there are different types of small modular reactors, different technologies, different ways to really build out the nuclear infrastructure on a small scale, but in a big way. So what these small modular reactors are really designed to do is, instead of having these huge power plants built, and they're very expensive, especially nuclear power plants, it's, okay, how do we build these on like a assembly line, right? And then ship them and move them to where they can be put in place. Obviously, their output isn't as large, but if you can build thousands of them at a time, over months, you can suddenly deploy these in a more efficient way, more cost-effective way. And that's very important, especially when, if you look at the lifetime cost of a nuclear reactor, it's very much upfront. It's high initial capital costs, and the uranium that goes into it and the maintenance is relatively low. Versus your carbon-based power plants, right? That burn coal or natural gas or oil, etc. Those are the opposite. They're relatively cheap to build and set up, but obviously ongoing costs and certainly from a climate change perspective, more troublesome. So Oklo is one of those names that is getting a lot of hype. And it's moved up pretty dramatically from $5.35, its 52-week low back in September. Now we're at $30.91, but well off its high just a couple of months ago in January, close to $60 per share. So still down 50% since then. So you can see how volatile this name is. Now it's losing money, will continue to lose money for the next couple of years. And this is all about momentum, hype, and speculation. Will they get government contracts? Will their technology be the winner out of the others that are out there? That's what you're really playing here. The way to look at this, once again, momentum. It's still in an uptrend. It's making higher highs and higher lows. It has pulled back dramatically, and this would be a good entry point. However, if you do get another rollover of speculative names like you have over the past couple of weeks, this will probably go with it. Just like it did, right? It pulled back starting when kind of the NASDAQ peaked out. Okay, so to expect that correlation to break probably won't, right? The NASDAQ peaked out on February 20th, and this peaked out on February 14th is when the decline started. So it actually led the market a little bit. So that correlation there, like I said, isn't going to break. Now, do I like the nuclear industry? Yes, I love it. I think it's great. But this is highly speculative, and you have to be very, very willing to handle the ups and downs if you're going to hold it for lengths of time. But as a trade for short-term balance, maybe back into the 40s, I kind of like it. But understand that I near-term, just a lot of volatility. I'd rather go with a different play myself. Thanks for the call. Now, I hope you've been telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, and on YouTube. And if you have any questions, you can submit them over there in the comments section. So let's gather one of those now and answer it. Ish1412 says, I would like to know your opinion on WBA going private deal. Should I sell now and wait to see if I could get any of the extra $3 shareholder could get for Village MD monetization? I look forward to hearing your response. I'm not particularly familiar with that Village MD part. Let me see here. I know Walgreens did get a buyout offer from, I believe it was private equity, and it's largely traded sideways around $11 per share. Let me see what the buyout number was, because that'll be interesting to see if a buyout's closer to 14. That's a pretty large difference. You notice I do answer these live here. Okay, so this was on the 7th. And I'm not seeing a price here. Now, typically, typically these things do go through. If it's, more than 4 or 5% from where it is now, I'd probably wait on it, to be honest with you, because I do think this will come through. And yeah, $10 billion deal. Sorry, I'm just trying to kind of gather this data. Okay, yeah, so it's slightly higher than here, around $12. There's minimal upside, I think, if it's $10 billion, because right now 9.6 billion is the current market cap. So, there's modest upside, but it could certainly fall through. This kind of goes either way. I usually take the money and can reinvest that money in something better. Okay. Let's go talk to Sid in North Carolina, looking at KB Homes. Do you own it or looking to buy it?
Hi, Justin. Good evening. No, I don't own it. I just heard few things, and I think today it went down in the after hours, maybe because of the earnings, something. So I thought I'll just check your feedback. If this is a good company to get into at this price, or do you have some other opinion? Thank you so much for your time.
No problem. Thanks for the call. Now, it is down after hours. Let's see. Yeah, it looks like earnings did miss. So it's down to after hours around $57. So really it is finally at major support here around 57. So that's a good thing. But obviously an earnings miss is not a good thing. Now we'll see what the ultimate reaction is here. In KB Homes, it's definitely one of the better home builders that are out there, but it's not my favorite, to be honest with you. Obviously, tariffs are going to hurt the home builders that focus on lower price options, first-time home buyers, and they do operate in that market. And so that's a bit of a worry. And, if you do get a recession, a layoff cycle, that's going to hurt the demand for homes. But obviously, lower rates would help demand for homes. And we do have a housing shortage overall. So I do like home builders in general. Once again, KB Homes is not my favorite. I do think we are on the precipice, though, of a national home price decline this year. Now, I don't think it's going to be major. I think it's going to be the low single digits, 1, 2, 3, maybe 4%, something like that. And so KB Homes would certainly have some pressure there, and I'm seeing some pressure overall. And so, this is an area that I'm over the medium term, I'm more bullish on, but in the short term, I don't like the relative strength if I just go over to like an ITB. This has been in a downtrend since October, and it's not really getting much traction here. So I'd be patient on it. I would look for others within the industry. This is a good one. It's above average, but I think there are better ones within the industry that you could buy. Okay. Thanks for the call. Now let's play a caller question from 888-99-CHART.
How are you doing? Tom from Atlanta. I'm calling about CAF, CALF. It is a small cap and a little bit of mid cap. Cash cow ETF is what it's kind of brands itself as. So I'm looking to get some exposure. I'm thinking maybe this might be a good play right now. It's been beaten up over the past probably year and a half or so, down a good bit, sitting at about 11 to 12 PE. Of course, most of the companies in there make money. That's the whole cash cow theme. I'm wondering if this is a good time to get in or if it still has a ways to go down. Thank you.
All right. Looking at CALF is the symbol. This is the Pacer US Small Cap Cash Cow 100 ETF. So what this is, it's a small cap index, and it ranks the companies. I believe it looks at, I don't know if it's the Russell 2000 I'm not sure which one they use, but one of the small cap indexes, maybe it's the S&P 600. There's a few small cap indexes out there, and they're ranking them based on cash flow. Now, one of the issues with when these funds rank based on metrics is, a cyclicality of that metric, especially cash flow. Cash flow can be very cyclical. It can be great when times are good and can be very terrible when times are bad. So a lot of it has to do with their filtering process, and they could be overweight particular sectors at the worst time. So right now, the weighting is in consumer cyclical 20% versus the category is 12%. So that area of the market has struggled, especially the smaller companies. And that's an issue. So no financials here, and financials are doing really well, up 24%. 24% is the category average. It's at 0. So it hasn't had some of the areas that have benefited from a Trump administration, from an economy that is still relatively low unemployment, et cetera. And it's overweight energy. Energy has struggled as of late, but starting to get better. Industrials, it's about the average for the sector. So I think that's fine. Technology, it's a bit overweight because technology companies do have pretty good cash flow, but obviously some of them are trading at high multiples. So it doesn't necessarily mean that you're getting great deals just because they have good cash flow. So, and then you look at the debt profile, how much debt do these companies have? It's not just about cash flow, but stability of balance sheets, et cetera. So this one has certainly underperformed. Now, I generally like to look at cash flow. I do think it's important, but you kind of have to look at it in context. Do I like this better than just buying an IWM or a S&P 600 ETF? Yes, I do, but it's not a panacea. It's not something you are paying above average fees. I would rather own individual companies and be able to do our analysis, what we do for clients. But if you don't want to do the work here and you just want something that focuses a bit more on cash flow and you want exposure to small caps, then this is a pretty good ETF for that. Now we have time. So I think we can fit in one more listener question that came in via our YouTube channel comment section. Blackberry7 says, what are your thoughts on CGW ETF? Thank you and take care. All right, looking at CGW. And this is the Invesco S&P Global Water ETF. Now, it is a bit on the expensive side. It's 59 basis points is its cost. So expense ratio, 0.59 basis points, 0.59%. And this is about 40% non-US stocks, about 60% US stocks. Now, you have 50% industrials, 40% utilities, 5% basic materials, and a smattering elsewhere. Now, one thing I like is it's global. So you're getting some foreign exposure here. I like that. But you are concentrated in a few names. So you have to look at the overlap and exposure that you're going to get with industrials, with utilities. Do you have that other exposure elsewhere? And are you going to get more too exposed to one particular sector? So I would worry a bit about that. It is a bit expensive, so I wouldn't go hog wild with this. I would just have maybe a small percentage. Now, the bigger question is, are water companies more profitable in the industrial space versus the utility space? Or are you better off just buying a global utilities ETF or in a global industrial ETF and getting more broad-based exposure to those sectors? That would be my only question. I would do a deeper dive into what those options are. And I think you would be better off going in that direction versus this because of the cost, because of the just simple focus on water. Now, personally, like I said, I haven't seen anything that water companies are infinitely more profitable and better investments longer term. Until I see that data, I would want a bit more diversity than just something that's focused on water. Now, the InvestTalk voice bank never closes. You know that. So let's drop in another listener question from 888-99-CHART.
I called to ask about bond maturity. How do I know when a bond is at maturity? Is that based on when I purchase? Is there a date that is specified that I need to look into? I'd love to get some insight on that. Also, speaking of bonds, what do y'all think of bonds such as ticker symbol ANGL, Fallen Angels bond? I'd love to get some insight on all that I just asked about. You guys rock. Keep it going. We all learn a lot from y'all, so keep your knowledge flowing, please. Thank you. Have a great day, y'all.
Appreciate the call. And yeah, very simple. Every individual bond has a maturity. There are some perpetual bonds out there. They don't technically have a maturity date. They just pay an interest rate. But almost every other bond out there has some sort of maturity date. So for example, you asked about ANGL, which is the VanEck Fallen Angels high yield bond ETF. So pretty high yield, 6.5% yield there. But its credit rating is B+, and it has a lot of kind of junkier names. Double B is where it mainly sits, 70% of the portfolio, but definitely has some lower rated names there. I don't love that, especially in the space, in the place where you're getting credit spreads widening out. I wouldn't be owning this particular name. Let me look at the chart here. Yeah, it's relatively steady, but yeah, I think there's definitely better options out there in the high yield or junk bond space. But going to that particular ETF, the top holding is Vodafone's 7% bond that actually matures. Oh, wow. In 2079. That's interesting. So that is a very long-term bond. And so that's when that one matures. So you can see the maturity date can be decades into the future. Versus its second highest holding is Celanese. CE is the ticker symbol of the stock, but this is a Celanese bond yielding close to 6.5%, but it matures June 15th, 2027. So in a little over 2 years. So yeah, every bond, especially on the corporate side, has some sort of maturity date on it. So you just have to look that up. And going back to Fallen Angel yields, the effective maturity is 11 years. So it has some duration risk there. You're getting a decent yield, but once again, not enough yield for me to get excited about this particular ETF, especially considering the higher expense ratio, about 0.25%, which is on the higher side for a bond fund. That was ANGL. Now let's touch a bit on private equity. Private equity, it has been a hot topic as of the last, let's call it decade. But there are some problems and some good things about the space. But, we're in a new era. We've said that for a while now. Higher interest rates, higher inflation, obviously geopolitical tensions. And the era of globalization is, if not reversing, certainly stagnating. And the question is, can private equity survive in that environment? Now, those in the space will tout that it has some magic formula. But if you go look at the data, there is no real magic skill within the industry. It's simply leverage. That's what they do. They borrow money, and it worked really well when borrowing money was very cheap, especially when you can lock up capital and borrow money at 4 or 5% for extended periods of time. Now that's no longer the case. If you want to borrow money for 10 plus years on a risky investment, it's going to be closer to 10%. Right? So the leverage now costs a lot more and eats into cash flows. Now, some will say within the industry that the fact that when something gets in trouble, when a company gets in trouble, the fact that it's private allows them to work it out with the borrowers and prevents panic losses and bankruptcies. And that, frankly, is probably the best argument here. Gives a little more control and allows the leverage to work, potentially. And frankly, that's it. That's by far the best argument. But to get that, you pay much higher fees. And you pay a premium to the market. So those within the industry will say that it's uncorrelated. It's an uncorrelated asset. Well, that's because It's not marked to market. It's marked to model. It's marked to whatever the managers say it is worth. And that is a major conflict of interest that is very prevalent within the industry. And so investors are getting a pretty poor risk to return investment. And the managers get high returns. Now, once again, in an era of low interest rates, it worked really well, but now we're in a different era, and will that model hold up? And the simple answer is probably not, but it doesn't mean that it has to go to hell in a handbasket tomorrow, that it has to all disintegrate tomorrow. It can be just a very drawn out experience that takes a decade plus for investors to get their money out, and ultimately they're probably not going to be very satisfied with the returns that they get. The latest Bain Global Private Equity Report said there's a lot of money still in the industry, but that the amount of money that is being deployed continues to drop. Why? Because there's just not a lot of good investments out there because of valuations. In fact, the amount of money that's idle just sitting there in these funds has risen from 20% to 24%. So they just don't have a lot of great things to buy. So this all adds up to an industry that is likely to be caught in a lot of malaise for probably the next decade plus. That's higher risk because of the geopolitical uncertainty, the higher cost of capital, the cyclical, the volatility of the economy, et cetera. And that's why I think private equity is going to struggle for many years.
Hey, Luke and Justin. Bill from Philadelphia here. Was interested in adding a REIT or two into my portfolio. Wanted to get your opinion. The first one on Realty Income, ticker symbol O, and the second one, VICI Properties, ticker symbol VICI. Wanted to get your opinion, which one that you guys thought would be more beneficial, or if possibly even both of them are. Love what you guys do. Thank you.
All right, these are both very solid REITs. Realty Income is one of the largest REITs out there with a market cap of $50 billion. And this is a retail REIT, fairly well diversified, has 250 tenants, 49 states, 47 different industries, from industrial, gaming, office, manufacturing, distribution facilities, etc. So I like that. I like that diversity there. VICI Properties, not bad itself, $33.7 billion market cap. It's a little more focused on gaming, hospitality, wellness, entertainment, etc. So it owns places like Caesar Palace and MGM, the Venetian in Las Vegas. And that's where it focuses, those big properties that probably aren't going anywhere. And so we like both. Frankly, that would be my answer, is a little bit of both, because both have solid yields and fairly good diversity. But I would say O is probably a bit safer because of that diversity. Thanks for the call. Now, lastly, let's touch on the popularity of Roth IRAs. So we are in tax season, and there's some interesting new data that shows that Roth IRA owners, 41% of those were under 40 in 2022. That's up from 28% in 2016. So younger people are getting better at saving in these type of vehicles. Now, this is, to me, a product of one of the good signs of social media. It's a lot easier to get the information you want. More people are listening to podcasts like this. More people are on YouTube and social media and seeing influencers. Now, frankly, IRA talk is typically boring, so maybe it isn't touched on as much. But it's a real thing and it's important to start saving early. And these Roth IRAs are, I think, the best vehicle for the younger generation, mainly because they're in lower tax brackets. That's what it's all about when you're putting money into a Roth IRA or 401k versus a traditional IRA or 401k. It's all about tax rates. And once again, young people typically don't make nearly as much as what they will later in life, and therefore they're in the lower tax rate. Now, another factor here is that some of these brokers are actually offering incentives for them to open and contribute to Roth IRAs. So that's helpful. And they're starting to realize that this is a good savings vehicle as well, not just an investment vehicle, but a savings vehicle, because you can access, after 5 years, the contributions in a Roth IRA at any time, penalty free. Not the growth, but the contributions. So that's good as well. And since we're in the midst of tax season, we're only roughly about 3 weeks away from tax day, you can still contribute to your IRA or Roth IRA for 2024. So if you haven't done that yet, it's a good time to do it. Don't do it the last day. We get that all the time. Hey, I want to do that today. Well, it becomes more of a challenge, right? So get on that now. And while you're at it, make the contribution for this year. Just because you have all the way until April 15th of 2026 for the 2025 contribution doesn't mean that you shouldn't do it now. Because the sooner you get that money in, sooner it is ready to pounce on opportunities when there are market sell-offs. So I wanted to highlight that, give you a bit of good news that while the younger generation, they have more trouble being able to buy a house and finding financial success, they are doing some smart things with their money and putting it into these tax-deferred accounts and tax-free accounts. That's what a Roth IRA is once the money is in. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And if you need help understanding whether your portfolio is ready for this next few years of volatile economic and geopolitical times, I encourage you to reach out to myself or Luke at our company, KPP Financial, where we practice parallel investing, which means you invest right alongside our clients. Independent thinking, shared success. It's InvestTalk. Good night.